Rick Rule of Rule Investment Media. I think we got a lot. I mean, I know I have a lot to ask you. Can you hear everything well on your side? Is my audio clear?
Yeah, unbelievably clear. Wonderful.
Okay.
These little toys are wonderful.
Fantastic. So it's interesting because I saw that you posted yesterday. You're new to X, but you have 55,000 followers. How can somebody who's new to it have accumulated 55,000 followers?
Well, I guess an example of my naivety is I don't know. My original familiarity with Twitter was sort of, 5 years ago, and I didn't have much interest in an audience whose attention span was limited to 140 characters. I'm, sort of interested in talking about and teaching complex topics, and that message isn't accomplished well in 140 characters. As the capabilities of Twitter increased, my interest in it increased. And finally, people in my own sort of ecosystem said, Rick, you need to sort of bull your way into the century, which I've now done. As to how I found 55,000 followers, I need to tell you, those people found me.
Mhm.
I had no no ability, as I'm sure you learned today.
Yeah, it's powerful though. It speaks to who you are and that you do have quite a large following out there. I'm not even sure there's 55,000, investors in the junior mining sector in the entire world. So obviously you have accessed.
N- Now,
Uh,
now, now, there, I know a lot. In my own universe at Rule Investment Media, I think it's now 81,000 double opt-in subscribers. That's one definition, a fairly small or limited definition of the audience. There is a file of over 500,000 investors who subscribe to more than one, that is, pay for more than one hard money publication. So, by that definition, the worldwide group of junior mining investors who are willing to pay for investment advice is 505,000. And in two prior efforts, one at Sprott, which was helping Sprott build the exchange traded physical precious metals franchise, which now exceeds 270,000 shareholders. That was mostly an online constituency. The second data point would be the building between 2000 and 2014 of the Everbank um, depositor community, which is 250,000. So I would suspect that the user base, the online user base around junior mining stocks, is probably in the 500,000 range, if that's helpful.
yeah, no, that's very helpful. I was being a little tongue in cheek in my comment about the 55,000, but
Okay.
considering that PDAC is the largest mining conference in the entire world each year, and it draws roughly 25,000,
Right.
to have as many followers and subscribers on your list as you have is extremely impressive. So you've definitely reached out to a bigger following than most people in this industry are able to obtain. There's a lot of things I want to touch upon. There's a lot of different areas I want to delve into, and the point is well taken about 140 characters. And the capabilities of the platform have evolved and they have expanded a great deal. In fact, you can write an entire blog post and post it as a tweet now if you want. That's usually not the way most people do it. They usually do it in a thread format, but it's the capability is there, and you can post videos that are 30 minutes long if you want. Right, the capabilities have expanded greatly, but still, even with all that, the tweets that get the most recognition, the most engagement, are the simplest ones, where it could be one sentence, one picture, one graph, a video, a short and sweet, video that's still what captures people's attention. And we have increasingly shorter attention spans. So, how do you deal with that? This world of shorter attention spans, and everybody wants it in a soundbite.
Well, I think for me, what I'm probably going to do is ignore what the people who I don't believe I can serve want, and use broadcast, which is to say, Twitter and other social media, to attract out of an extremely large audience a smaller audience that has an attention span and an interest where I believe I can be of use. I'm 71 years of age, old, fat, rich. I'm not doing this to attract followers. I'm doing this to become part of various communities where my experience can add value to other members of that community. And the lessons that I have to teach don't lend themselves to emotional responses to short form content, which is one of the reasons why I love to be interviewed. I leave it to you as the host of your own community to understand your community's interest. And rather than trying to script an interview like this, where I prescribe to your audience what they ought to be interested in, they reflect what they're interested in through you to me. That's why things like this are so useful to me.
Yeah, that makes a lot of sense. Yeah, it makes a ton of sense. So let's talk markets. Let's talk metals. A thing that I think the two of us both know a few things about. You are a contrarian investor, and I've watched you be interviewed a number of times, and you usually stay on message that you're either a contrarian or a victim, especially in the junior mining sector. Let's start with gold. So we won't delve into the mining stocks yet, but we'll start with gold and the recent gold market action. You're a contrarian investor. Is gold still a contrarian? Is gold still a contrarian place to be for an investor?
Absolutely. On Wall Street and in the minds of most high net worth retail investors and almost all institutional investors, despite the fact that gold's a four-letter word, most people can't spell it. It's an irrelevance. Those of us in the community are interested in the fact that gold now has a pulse, but gold's relevance in modern finance is as non-existent as it was in the 1960s, which is where I think the opportunity was. Until 15 or 16 days ago, retail participation in the gold business was negative, which is to say there were more redemptions in gold ETFs, physical ETFs, than there were additions. And the entirety of the relevant buying of gold was taking place, I would suggest, in central banks whose motivation had more to do with the monetization of the US dollar than gold's own properties. So I very much think that the gold trade is still a determinedly contrarian trade.
Determinately contrarian trade. That's interesting. And I totally agree with you. I was in Vancouver in January, spoke at MIF, and one of my key talking points was that nobody owns gold. So even gold was $2,000 an ounce at that time. And I still, based upon all the data I've seen and people I speak to, nobody really has any real exposure to it. Maybe that is just starting to change right now. You've also drawn some parallels to the 1970s. So I wasn't alive, but for a few months in the 1970s, but my father was. And so my father passed down a number of stories to me about the gold market of the 1970s. And I noticed you saying that this is like we're in 1976. Why are we in 1976? And what happened over the next few years?
If I said that, I made a mistake. I think we're in 1974. Uh, and let me try and explain. I was, I was not unborn, but I was fairly young in the latter part of the decade of the 60s. I was born in 1953. But I started becoming interested in finance in 1966, 1967 at a fairly young age. And I, and I'm not sure how, I became interested in precious metals in a defensive mechanism at that point in time. The writing was on the wall, at least in the United States, for people who were concerned about debt deficits and inflation, really beginning in 1967. But because investors had been through 20 very good years, the period 1946 to 1965, 1966, despite the fact that the writing was on the wall in terms of a sea change in fortune, nobody cared. Uh, the US fought the war on poverty, we lost. We fought the war in Vietnam, we lost. And the consequence of that is that we had very large debt and deficits, which were relative to the size of the economy and the structure of the economy, unserviceable. And it was fairly clear that the only way out was going to be reducing deliberately the purchasing power of the US dollar through the decade of the 70s, which occurred. But nobody gave a shit. Nobody cared. The early signs of inflation, which went through the market in terms of pricing levels in 1970 and 71, were unnoticed. The shift from a demand pull equation to cost push equation, which is to say, when working people began to demand pay raises, at least those who could, unionized workers, uh, began to run through the economies in the early part of the 1970s, and nobody paid attention. It took probably 5 years for individual investors and the investment community to understand what had happened in the previous 5 years with regards to the deterioration of people's purchasing power in U.S. dollar denominated savings and U.S. dollar denominated wages. When that happened, late 1973, early 1974, um, the response was really dramatic. First of all, gold had, of course, been price controlled. And the fact that it came off of price controls changed it from sort of $35 an ounce to $75 an ounce, a dead cat bounce, if you will. But the move from $75 an ounce to $800 to, pardon me, $200 an ounce, which occurred over 1973, 1974, really had to do only with a market awakening of the fact that all was not as good as people had come to believe. Uh, that's similar to today in the sense that we've come off a 40-year bull market, lowering interest rates and strong US dollars in the period 1982 to 2022. I would argue with you that in 2022, that party changed, that the increase in interest rate had a lot to do with the fact that at least the big thinkers were concerned about inflation. But that concern didn't flow through to individual investors and certainly didn't flow through to Wall Street until very late. Now, and I'm sorry for this long-winded response, but I think it's a very important question in terms of the work I do. What happened in 1974 is that the big thinkers suddenly became very concerned about fear. And they raised interest rates fairly precipitously at that point in time. So in 1975, we saw a real dramatic Fed tightening. And that Fed tightening did a whole bunch of things. Among other things, crashed the gold price from $200 to $100 an ounce, really, truly spanking the faithful. And a lot of people got shaken out of the gold trade in that really precipitous decline. I'm not suggesting that's going to happen now. I'm just giving you the benefit of history from somebody who lived it. The other thing, of course, that rapid increase in at least the nominal interest rate did is it obliterated the long bond market for a little while, hurt the equities market, and really hurt housing starts. So that by the end of 1975, the Fed lost their nerve. And when the Fed lost their nerve at the end of 1975 and cut interest rates, the market was already conditioned to be concerned about inflation. And the people who got shaken out of the gold trade in 1975 missed a move from $100 an ounce to $850 an ounce over 5 years. I hope that history is useful to the younger listeners on this call who have some sense of why I'm so bullish about the gold trade based on my own personal history.
Yeah, that is very. There's a lot to unpack there. The Fed lost its nerve in '76, and gold went on a tear from '76 through the first month of 1980. 1979 was one of the best years in the history of gold market and gold mining stocks ever.
Yep.
And as you said, gold investors who were invested in the mining stocks got shaken out in 75 and they lost faith in it. And they missed one of the greatest 3 to 4 year runs in history. What are the parallels to today's gold mining market environment where we just had two very bad years, 2022 and 2023, where many of the senior miners performed horribly in the face of a relatively robust gold price? Obviously, not robust like this morning, but gold has still been 1900 to 2000 for much of the last couple of years. And meanwhile, companies like Newmont and Barrick have been horrible performers. And I'll just add one more and then I'll let you answer the question. Um, at the end of last year, it was surreal to me the sheer amount of hate there was for the gold mining sector at the end of 2023. So even as gold was picking up at the end of 2023 and we were moving well above 2000 in the final weeks of the year, my finger on the pulse of the investment public was telling me that nobody wanted a part of this and nobody wanted to own any of the gold mining stocks.
You said a lot there, so let me respond to it sequentially. First of all, you mentioned the hate that the sector engendered. If you're a contrarian, that's an extremely bullish sign. There's nothing in the world I like as an investor quite so much as hate. Uh, if you follow the old Buffett adage about buying low and selling high, first one must buy low. And you don't buy low in a market where you have lots of competitors. The fact that we have no competitors is, I think, an absolutely wonderful thing. If your orientation is to the quarter, then hate's a bad thing because there's momentum, or if there is, there's negative momentum. That isn't my orientation. My orientation is to a half a decade. The second thing is that the hate that the gold industry enjoys currently, they deserve. The key difference between the 1970s and 2024 with regards to the industry is that the industry came into the early part of the 1970s having been in the doldrums at best since the 1920s, which is to say that the industry was deeply out of favor, had a very high cost of capital, and had struggled to survive, which is a different way of saying they were extremely efficient. Darwinian market forces had allowed a couple companies to uh, continue to exist in the face of price controls on their principal commodity. These were high quality, lean, mean businesses. By 2022, that had, of course, all changed. Investor perception around gold nowadays, I think, was set by the experience that investors enjoyed in the 1970s. A rising tide floats all ships. And investors came to regard gold shares, first of all, as not fractional ownership in businesses, but rather ticks on a chart, something like a cryptocurrency, not reflecting the underlying fundamentals of a business. And what the investors were really truly looking for a very long time, was a proxy, a leveraged proxy for an increase in the gold price rather than an efficient business. Uh, Not surprisingly, The most highly leveraged businesses are the most marginal. If you're a high cost producer, your margin increases in response to increases in gold prices faster than a more efficient producer. Investors asked the industry to be leveraged, which is a fancy way of saying marginal, and the industry complied. The industry is out of favor because it's a shitty industry, and it's our fault. If you look back again in history in the period 2000 to 2011, the gold price increased sevenfold, over sevenfold, from 250 something an ounce to 1900 an ounce, and free cash flow per share on the XAU declined. I mean, it took real skill to screw up a market where the selling price of your product increased sevenfold. So the expectation that those few investors who care about gold still have for the industry is lousy. There are certain things too that initially in a bull market are a little bit beyond the industry's control, which is to say, the increases that we've seen in the gold price, certainly in the period 2020 to 2024, have been more than matched by increases in the input costs to produce gold. Energy prices have roughly tripled. Labor costs, skilled labor costs, are increasing according to the industry at about 15% compounded annually. Cement has increased in price. Steel has increased in price. And according to one super major who I won't name because it was a private communication, their global social expense, which is to say tax, offsite fees, offsite infrastructure contributions, and royalties, have been increasing at almost 20% compounded for 4 years. So it makes sense that the increase in the gold price that we have seen recently, which is fairly recent, hasn't resulted in a dramatic increase in margin because costs have increased too. My hope is that the investors will hold the industry to a higher standard in terms of efficiency in the next decade so that the incredibly poor market performance that marred the industry in the period 2000 to 2010 won't be repeated. And we're certainly seeing good signs of that. Free cash flow in the industry are, at least with regards to some of the better producers, pretty good. And capital allocation in the last 5 years, perhaps in the face of lower amounts of capital available, have been, I think, very good. So I'm optimistic about the sector, but I need to say I'm particularly optimistic about the sector simply because the sector is experiencing so much hate. I think that that hate, at least in the next 2 or 3 years, will lead to efficient management decisions with regards to capital because their capital, represented by their share price, but also the terms under which they have access to credit, is so constrained. There's no capital discipline in the world like a high cost of capital and hate. And ironically, I think that's a benefit to the industry.
So because the cost of capital has gotten so high for the gold mining industry as a whole, they've been forced to tighten things up and lean out all of their operations. And in the case that gold continues this big uptrend, it should generate, it should flow through to the bottom line in this next cycle. I mean, is that what you're saying?
I don't think it will to the sector. I think it's important to say this. I think that the sector and investors in the sector are almost serially corrupt and stupid. I think if you invest in the sector as a whole over 20 years, you will go broke, or at least you'll lose a lot of money. I think what you need to recognize is that our sector, like any other sector, is composed of, in movie parlance, the good, the bad, and the ugly. And I think that paying real attention to stock selection is what's going to work. I think the performers who understand the game and perform well are, as they have in past cycles, going to make you so much money that they will add legitimacy and even luster occasionally to a sector that has traditionally been a place that money goes to die. I don't mean to be so stark, but I think that equity investment performance is going to be about stock selection, stock selection, and stock selection.
All right, and that's where you come in. I do want to delve into some more details of trading psychology, of market psychology, of investment psychology. But I want to ask you one more gold question. You were recently quoted as saying $9,000 gold price is not far fetched. It seems pretty far fetched to me. I'm not sure I would want to live in a world with $9,000 gold, at least not $9,000 in the next few years. Today, we have potential war breaking out between, Iran and the Israelis. Perhaps it's a little bit overblown, but it's still scary nonetheless. That seems to be at least part of what's driving this gold and silver move. Why is $9,000 not far fetched?
Well, by the way, I just picked a number out of the air. Um, it amused me monitoring social media to see how excited people were in a move from 2150 to 2275 or whatever. To me, that's sort of a fart in a windstorm. It doesn't matter. I think that the set of circumstances that moves gold really involves uh, a declining confidence in the purchasing power of savings and investment products denominated in fiat currencies. And I think those fears are very real. The move that makes sense to me in terms of the market isn't necessarily the move that we saw in the 1970s, because gold began that decade price controlled. You began from an artificially low base, and there weren't as many investment alternatives to people to shelter their savings from the ravages of inflation. There weren't as many competing opportunities as there are today. But I think that the move that the industry saw in the period 2000 to 2010 is roughly analogous. The gold price increased sevenfold then. Whether it increases this time threefold or fourfold or fivefold or tenfold, I can't tell you. I just think that we have the building blocks in place for an increase in the gold price that's an order of magnitude more important than the market assigns it. Let me give you some statistics to support this. These are J.P. Morgan Chase numbers, not Rick Rule numbers, by the way. J.P. Morgan Chase suggests that the market share of precious metals, physical precious metals, and precious metals investment products, including securities and debt, in the U.S. market has a market share of less than one half of 1%, which is to say that less than one half of 1% of total U.S. savings and investment assets are denominated in precious metals. JP Morgan Chase further suggests that the 4-decade mean market share of precious metals was 2%. They estimate, because they don't have sufficient data, that precious metals peak market share occurred in 1981, where they suggest that it was probably in excess of 6%. I'm not suggesting to you that the market share of precious metals and precious metals related investments will ever exceed its prior highs. I believe that the market share of precious metals and precious metals related assets in the US market, the market that I'm most familiar with, will revert to mean. If I'm right, that means that the market share will increase from one half of 1% to 2%, which represents a fourfold increase in demand for this asset class. I don't know, understanding that prices are set on the margin, what price level to expect as a consequence of reversion to mean. What I do know is that if I'm right, and who knows if I am, the idea of a $30 move in gold or a $100 move in gold over the course of 5 years or 6 years, whatever period of time a reversion to mean requires, would mean that a $20 move or a $30 move or a $100 move would be absolutely positively irrelevant. So I look at the period 2000 to 2011 as the analog that people need to study and concern themselves with.
And so 9,000 you pull out of the air, but
Yeah.
it does make some mathematical sense if you go back to that 2000 to 2011 market where gold was basically like a 6x over that time frame. So at
7x,
least
7x, 7x.
7x. Okay, 7x. All right, let's switch gears. In chess, there's a saying that strong players make their own luck. I'm a chess player.
Yep.
How does a junior mining investor make their own luck in the junior mining sector?
Thank you for the opportunity for a commercial. Go to the real classroom. I have 200 hours of instructional programming there. The truth is that there's a few things that you look at. In the junior sector, getting away from the senior sector, I would suggest to you that the most important variable is human. Those of you who have suffered through this lecture before, I'm sorry, but you need to pay attention to a social science dictum known as Pareto's Law, the 80/20 principle. That would suggest in common parlance that in any given task, 20% of the population generates 80% of the positive utility, or we call it the 80/20 rule. Two things are important to note. There's a good 20. There's a 20% of the population that generates 80% of the positive utility. There's a different 20% of the population, this is a bell-shaped curve, of course, which generates 20%, 80% of the aggravation. So if you look in junior markets, uh, 20% of the population generates 80% of the value, and a different 20% of the population generates 80% of the losses. What's important to understand is that this population is so big that if you take the two lips, the positive 20 or the negative 20, and you run them through the same performance dispersal curve, they conformably align, which means that 4% of the management teams generate well over 60% of the gains. So the first part of understanding how to make money in junior mining is to hang out with the serially successful people. Hang out with the people who have long and consistent track records. But go deeper. Make sure that the track records of the management teams that you're hanging out with conform with the task at hand. If somebody has been successful because he or she operated a producing gold mine in Archean terrain in French speaking Quebec, but the task at hand is exploring rather than operating for copper gold porphyries in 15 million year old accreted terrain uh, in the Spanish speaking Peruvian Altiplano. While they may have been successful, the success isn't suited to the task at hand. So the first part of success in the business is uh, are the people involved successful? Are they committed? Do they own stock? And throughout the organization, not just in terms of the chief ego or the CEO, are their resumes suited to the task at hand? You will have accomplished 75% of what you need to accomplish if you would pay attention to that single data point. Hi, Sam. Friend of mine just joined. Um, the second thing is that you do need to be a contrarian. Had I been conducting this teach-in 2022, the whole thing would have been about uranium. And not many people would have showed up because the uranium price was at $20 a pound. Uranium was cheap. Uranium was dead. Uranium had momentum and nobody cared. But that's precisely when you wanted to be in the uranium trade. You wanted to buy uranium at $20 when it had to go up. Now, if I did a teaching around uranium with the price above 100, probably 1,000 people would turn up. I'm not saying uranium's a bad place to be. I'm just saying that the easy money has been made. The fact is, I think that the easy money is ahead of us in the gold equities trade. So, in addition to hanging out with the best people, you have to be in a sector that is, if not hated, at least a generator of boredom. And gold cooperates. In juniors, too, you need to understand that it is not as much of an asset intensive business as people believe it to be. In the exploration business, as an example, if you follow the statistics that 1 in 3,000 mineralized anomalies becomes a mine, the Howe Street or Bay Street value proposition is that you take a 1 in 3,000 chance for a 10-to-1 return. This makes the lottery look like a good deal. What you need to understand is that this is a knowledge business, and to make money in junior mining stocks, you need to understand the thesis, and you need to understand the proposal by which the thesis is going to be addressed. You need to come to understand that making money is a function of answering a series of unanswered questions. When I approach junior mining companies over the last 40 years, and I ask them the question, what is the thesis? How do you propose to unlock value? And what is the most important unanswered question? In approximately 80% of the interviews I've conducted over 40 years, the managers said to me, we've never thought of it in that regard, which means that the principal unanswered question to them is, how am I going to raise enough money to pay my salary for the next 18 months? A question that is of value to them, but none to me. So I would suggest to you that the pathway to success in the junior sector begins with people. Uh, it goes through towards contrarianism, which is to say, when the market recovers enough that you think you're smart, sell some stock and go to some place that's hated. And then it goes to answering unanswered questions. I would suggest to you that money is made, real money is made, uh, simply by the delta between price and value or expected value, which is to say, if the target size, let's say, of an exploration venture is 1 million ounces of gold. So you start the world with a $2.4 billion in situ value proposition. And let's say that the evidence around that is simply a mineralized surface anomaly that has sufficient superficial extent that you can surmise 1 million ounce deposit. So you have to discount back the steps to get to this $2.4 billion valuation. It might be that the first unanswered question is this superficial mineralization consistent? And it might be that you propose to test that with a series of, let's say, 15 trenches to, you know, develop lateral extent and whether or not this is transported. And you might decide as a speculator that if we can determine the validity of this 1 million ounce target, that it's entirely likely that what is currently a $10 million market cap will become a $30 million market cap. In other words, you'll have a better target for drilling. So then the circumstance is, how long does it take to answer the question? What's the probability of a yes answer? How much does it cost? And does the company have the money? You know, it's pretty simple. So let's assume, just for fun, that you're part of a financing and the company uses the financing in the time allotted to pay for the work that they've done and also pay for the G&A. And lo and behold, out of this surface anomaly, the trenching reveals a legitimate 1 million ounce target. Uh, Three things can happen here. The first is that uh, the market can digest the news that you've seen, and the stock goes up to your target, 30 million market cap. In that case, you need to examine what's the second stage of value creation. What question now is proposed by the data from the first test? What is the probability of success? How much does it cost? How much time does it take? And do I want to stay in for the ride? The second possibility is that the data can all be good, which is to say it's a yes answer, but the market doesn't respond. And the stock, rather than going up to the $30 million that you think it should be worth, is selling for $10 million still. This is a wonderful outcome from my point of view, because it means that you can buy more stock with more certainty at the same price. In other words, you can increase your exposure to a successful effort because you're right and the market's wrong. The third alternative, of course, can be failure, which is the trenching program shows that the initial expectation in terms of target size wasn't met. In this circumstance, you sell the stock. When the reason to own a stock goes away, the stock must go away. Thousands of investors have said to me, you may know I've graded thousands and thousands and thousands of portfolios. Thousands of investors have said to me, they'll own some idiotic share, uh, Amalgamated Moose Pasture Mines or something like that. And they say they can't sell it. And I say, why? Well, I paid $1 for it. It's selling for 40 cents now. If I sell it, I'll lose 60 cents. And I have to say as gently as I can, no, you've already lost the 60 cents. The question is, what are you going to do with the remaining 40 cents? If you want to own it at 40 cents, it has to be a compelling buy at 40 cents. And in that case, if you liked it at $1, you better like it at 40 cents and you better buy more. If you're not willing to buy more, you need to sell. It's that sort of simplistic but hard-headed thinking that allows you to survive and thrive in a place like junior markets because you're competing against an audience whose level of sophistication revolves around got a hunch, bet a bunch.
We started that question with chess, and we went a few different places, including a classic quote that I really liked: "Makes the lottery look like a good proposition. 1 in 3,000 shot at a 10 to 1 return on your money." When you look at it like that, it's pretty painful, and obviously that simplifies the proposition a bit, but definitely food for thought. I want to ask you, and maybe you can give us a specific example. I think, a specific example from your investments, I think would be very helpful. Let's take an example where you made an investment as a contrarian in a junior mining company. So it checked the boxes, the people, you really like the people, their track record, they had cash, or the financing that you invested in gave them enough cash to do what they needed to do to get the questions, answered, right? And you got lucky, right? So the lightning struck, and they found something, and suddenly the investment that was extremely out of favor and contrarian, and nobody was paying attention to it, was suddenly in favor. How do you trade that? So, the stock rose. When do you take profits? When does it become too crowded of a trade for you to stay in?
Oh my. I'm going to give a disclaimer. Uh, this example is a 1 in 10,000. It will never, ever, ever happen again. So don't think of this as a commercial. Think of this as an absolutely outrageous illustration. I hope everybody heard that. Um, in 1998, I became very interested in the restart of the uranium trade, having made money in uranium in the decade of the 70s. I was interested in uranium because it was so deeply out of favor. It had been in a bear market ever really since 3 Mile Island, which is to say the period 1981 all the way to 1998. The industry average cost of production, fully loaded worldwide, was about $30 a pound, and the industry was selling the stuff for $8 a pound, losing $22 a pound and trying to make it up on volume, of course. Nobody cared about uranium, and those who could hated it. So I wanted to be in the uranium trade. I had the good fortune to be in Western Australia at a conference called Diggers and Dealers, which still exists today. And I came on a booth of all things of a uranium explorer. Um, I didn't know there was such a thing among the juniors. And there was a wonderful guy behind the booth named John Borshoff. The company was, of course, Paladin. And I think they had $1.98 in the treasury. The market cap was a million six. And I said to Mr. Borshoff, how on earth are you going to raise the money to explore with a 1.6 million market cap and $1.98 in the treasury? He said, I don't have to. I thought, oh, this will be good. But tell me more, John. He says, well, you see, I was worldwide exploration manager for a parastatal controlled by the West German government, and they spent $1 billion looking for uranium. And when they shut the thing down, they gave me the database as part of my severance. So I don't have to explore. I just need to stake discoveries that I already made working for the West German government. That was the single best answer to a question I ever got in my life, and let me know I was speaking to a unique human being. So we financed them. As I recall, we put $2 million, a group of us, into a company with a million six or a million eight market cap. And because they couldn't raise any money anywhere else, we got a very fulsome warrant too. And I was feeling pretty smart about this, you know. And initially, the stock went from 10 cents to 12 or 13 cents. Immediate gratification always feels good. It turned out it did that because there was fresh blood. It did that because the fact that American investors came in gave the Aussie carnivores this sort of taste of fresh blood. But when that initial blush of success came off it, the stock went from 13 to 12. Okay. 12 to 10, not so good. I'm in at 10. 10 to 8, not so good. 7, 6, 5, 4, 3, 2, 1. Going down that old elevator, right? If you're into something for 10 cents and the stock is now selling for a penny, you don't have a hold. You have a buy or you have a sell. You have to revisit your premise, and you have to do one thing or the other. So I revisited my premise and I decided I was right and the market was wrong. John Borshoff had used the money that we had given him to stake three very large deposits. And he didn't acquire these by purchase, he acquired them by staking with no competition. So I had the courage to buy some more stock at a penny and a half. And I also had the courage to become an evangelist for the company. And in relatively short order, the stock retraced the 1 cent to 10 cents. And then in relatively short order, went to 20 cents. At 20 cents, I had to revisit my premise again. You know, I have an average cost now at 7.5 cents. And by the way, I have a 20-cent warrant in a 20-cent market. Uh, do I take some money off the table? I've got a double here. Do I sell enough that I get the rest of my stock for free? Remembering my dictum that the money is made in the delta between price and value or price and expected value. And I thought, no, I can, I can go with this. The market capitalization relative to what I think the value of the assets is still stupidly cheap. But I didn't have the balls to buy anymore. uh, 30 cents. Nice. The market's starting to recognize it. 40 cents. Well, at 40 cents, what I decided is that given my warrants were 20 cents in the market, that I should sell some 40-cent stock and replace it with a warrant exercise so that I could put more money in the table, more money in the company, which, by the way, I did. And I decided that I would begin to be a seller in earnest at a dollar. And really, I think it was 6 or 7 months later that the stock was, in fact, trading at a dollar. And I began to be a reasonably aggressive seller until I learned that the guy on the other side of that trade, which is the guy who was buying the dollar stock from me, was Ned Goodman, my mentor or one of my mentors. And I decided, yeah, I got to sell enough stock that I exercise all my warrants, put that money in the treasury, and I got to get all my capital off the table. A move from 10 cents to a dollar is such that if I don't sell some stock, I'm an idiot. So I sold enough at $1 that I exercised all my options, put the money, all my warrants, pardon me, put the money in the treasury, and I recaptured all of the capital I had invested in the trade, including selling enough that I was able to pay the capital gains tax on that stock that I'd sold. From there, I was a pretty good holder. And it wasn't until the stock got to about $4 and Borshoff began to believe that he was going to put these projects into production rather than sell them. And I wasn't sure he could do that, that I began to sell stock in earnest. At about $6 a share, if my memory serves me well, Borshoff decided the debt was a cheaper form of capital than equity, and began to employ leverage in the sector. Uh, Given that I was concerned about that, I became a fairly aggressive seller. By the time the stock hit $10 bid, which is an amazing move from 10 cents, to be honest with you, I didn't have much more stock to sell. But that stock which I did have remaining, I certainly sold. Um, that's the single best story of that type in my career.
Incredible, absolutely incredible. I mean, that is the dream investment for any junior mining investor, to get in at a cycle low for a metal when it's completely out of favor. I mean, it couldn't have been more out of favor in the late 90s. And then make a new discovery or three new discoveries when nobody's paying attention to it. And then hang on. Thank you for that story. I got two more questions for you, Rick, and then we'll wrap up on this Friday. Before we get into the Rules Symposium, somebody told me a story about a place called Sneaky Pete's. What is Sneaky Pete's, and why was Pete sneaky, and who was Pete? And what did that have to do with you getting involved in the junior mining sector?
As a young immigrant to Canada without much money, I had to have a job to get through university, and that job had to be at night because I was going to school during the day. The only transferable skill I had as a young American boy is I'd boxed for 10 years. And I found if I stayed sober and paid attention to my boxing upbringing, that I could be a pretty good bouncer, which is to say, guys that weren't as tough as they thought they were, that were drunk, were probably no match for me when I was sober. And through an odd set of circumstances, I went from being a bouncer to being a bar owner in really a fairly short period of time. And I became a bar owner of a place called Sneaky Pete's. It was called Sneaky Pete's because Sneaky Pete's at that point in time was the name of a highly popular bar in West Los Angeles, which is to say the name was stolen by the people who we bought the bar from. And the bar became easily the most successful of the sort of boy meets girl places in Vancouver, and was really the epicenter for the people who were the movers and shakers in the early sort of the days of the New York Stock Exchange. John Tognetti, who went on to found Haywood, was a regular customer. Peter Brown, who I would say is more responsible than anybody else for the genesis of the Vancouver Stock Exchange, was a customer. The whole range of the promotional community in those days, Murray Pesum, people like that, were all customers. And I, as a young man, was able to pour these guys free whiskey, ask them questions, run into the back, dutifully write down the answers in my 3x5 notebook without them knowing it, and come back and ask them more questions. I met, among other people who were later instrumental in my career, Adolf Lundin there through Peter Brown. It was truly an amazing place to control what was in effect a nexus in the Vancouver Stock Exchange and make a lot of money selling people the substance whiskey, which would loosen their lips and give me knowledge, was a uniquely valuable opportunity, which I must say, in my defense, I maximized.
All right, Sneaky Pete's. Yeah, that's quite a story. Final question. I have attended the Rules Symposium for 2 years in a row now. It's in Boca Raton, Florida, and I'm admittedly biased because it's about a 30-minute drive from where I live. So I'm happy that you continue to host it here in Boca Raton. Um, Tell us about the Rule Symposium and some of the things that you will offer there this year.
Well, thanks for the opportunity. Let me start by saying go to Rule Investment Media first. If you like what I have to say about resources, go there, list your natural resource stocks, and I will, for no obligation and no charge, evaluate them, rank them 1 to 10, 1 being best, 10 being worst. And I'll give you comments on individual stocks if I think my comments might have value. That's free. The Rule Symposium is not free. The Rule Symposium is sort of the granddaddy of natural resource investing related conferences in North America. It started in Vancouver about 30 years ago. It's now in Boca Raton, Florida, because of the ArriveCan app. My audience would not have done well going into Canada during COVID. But let's talk about the conference. First of all, it stood the test of time. It's been around 30 years. The second thing is that we do a wonderful job uh, on narrative, on macro, on big picture thinking. We try to get speakers who will explain the world as it is, as opposed to the world that the big thinkers, the CNBCs, the Trudeaus, the Bidens, would have you believe it is. The Jim Rickards, the Daniela DiMartino Booth, the Nomi Prinz, the Doug Caseys. But it's more the narrative. Narrative is entertainment. Narrative is something that shapes your mind. We have wonderful analysts there and wonderful portfolio managers around natural resources, people who have made money in resources for 3 decades, not investment banking morons who parachuted into natural resources because they failed at crypto or failed at supermarket analysis or failed at junk debt, but real natural resource people. More importantly than that, we have the living legends. We have a group of people who have built multi-billion-dollar mining companies and oil and gas companies from scratch, telling you about the process of doing that and telling you about how the lessons that they learned made them better investors and can make you an investor too. Unlike other conferences, our attendees have told us that our exhibitors are content too. They're not just advertisers. The consequence of that is that every public company exhibitor at the conference has to be owned in an account owned and or managed by me. That doesn't mean, unfortunately, that every stock I buy goes up. Far from it. What it does mean is that they've all been vetted. And in addition to being willing to give me a check to appear at my conference, they have to have been willing to take a check from me so that I put them in my portfolio. So they are all vetted. Uh, Maybe the most important part is the guarantee. If you pay the tuition to come to the Rule Investment Symposium in Boca Raton, Florida, in person, which I suggest you do, as an example, following Robert Friedland or Ross Beatty around the exhibit floor and seeing what exhibitors they talk to and listening in on their questions is worth the price of admission if you took no other content at all from the conference. But whether you attend in person or whether you attend, as 1,300 other people did last year, live stream from from the convenience of your own home, if you feel for any reason at all that I haven't delivered you value, that the content that I delivered you wasn't worth the tuition that you paid me, email me. There is a gold plated money back guarantee. No other conference on the planet offers that value proposition. July 7th through 11th, Boca Raton, Florida, or on your computer or your phone at home.
Rick, thank you for your time. This was a fantastic conversation. I feel like we could go on for hours. So let's table this and pick it up again in the future at some point. And I look forward to seeing you in Boca, this summer.
I make sure that you come and introduce yourself personally and do it on the boat cruise, and I will buy you the beverage of your choice. Thank you too for your tech support at the beginning of this call. Hopefully next time I'll know how to get on without quite so much prompting.
My pleasure. Cheers, everybody. Have a great weekend.
Thank
Thank
you.
you.